Welcome to This Explainer. Look, today we're going to unpack how you can completely stop guessing and actually start statistically proving exactly what market regime you're trading in. You know that feeling when your go-to trading strategy just suddenly stops working for, no apparent reason, and you're just sitting there staring at the screen in complete disbelief? Yeah, we've all been there. Well, if that sounds familiar, you're absolutely going to want to pay close attention to this one.
All right, let's just dive right into it. The fundamental problem every single active trader faces when looking at a raw chart is this. Is the market ranging, trending, or breaking out? I mean, staring at raw price action and trying to just feel out the answer, that's where the vast majority of trading mistakes actually happen. We're inherently wired to look for patterns, right? But our eyes can be so easily fooled by short-term noise.
So to completely solve this problem, we'll break down the rolling KPSS statistic across 5 crucial areas today: decoding market behavior, the KPSS inverted logic, level mode versus trend mode, reading the critical levels, and finally, visual feedback and settings. Let's get into it.
Starting with Section 1, Decoding Market Behavior, and specifically, the fatal flaw of subjective charting.
Here's the harsh reality. Our eyes deceive us all the time. Visual chart interpretation is incredibly subjective and, frankly, highly prone to error. And that easily leads to applying the totally wrong strategy in the wrong regime. Picture this. You might be running a range strategy in a market that's secretly, quietly breaking out. Or maybe you're trying to play a trend in a market that's just wildly volatile. You see what looks like a breakout, but mathematically, it could literally just be statistical noise. Relying purely on visuals is essentially just guessing.
Enter our solution, the rolling KPSS statistic. Now, this is a real-time trading indicator that applies the Kubiatsky-Phillips-Schmidt-Shin test, say that 10 times fast, over a moving window to measure if a price is stable or unstable. Think of this tool as your own personal statistical referee. Instead of you guessing, it continuously tests the underlying math of the price action. It tells you unequivocally if the market is behaving normally or if a real structural change is actually going down.
Moving right along to Section 2, the KPS inverted logic, basically how to actually read these statistics correctly.
Now, you really got to pay close attention to the mechanics here because this indicator actually works backward compared to what you might normally expect. Since the null hypothesis assumes the series is stationary, a low KPSS value actually indicates a stable environment with nice structured price action. On the flip side, a high KPS value is your warning sign. It warns of non-stationary behavior, think breakouts, instability, or a total regime change. So just remember, a low reading means the market is behaving itself, while a high reading signals chaos or, massive expansion.
It really all boils down to this absolutely crucial insight. A quiet market is not always tradable, and a trending market is not always unstable. This indicator measures actual mathematical consistency, which completely saves you from misreading the underlying structure. It adds this incredible layer of statistical market analysis that answers a very simple question. Is the market behaving in a stable way that actually fits your specific trading strategy? It's a total game changer.
Which brings us to Section 3, Level Mode versus Trend Mode. This is all about tailoring the analysis to your exact strategy.
Look, no two traders are exactly alike, right? And no two markets are exactly alike either. Because of that, this script offers 2 distinct modes, kind of acting like different blades on a Swiss Army knife. First up, we have level mode. This tests if price is stationary around a flat mean. Basically, it's checking if the market repeatedly returns to the same general area. This is your absolute go-to for ranging markets, mean reversion, and fade setups. But if that's not your style, we have trend mode. This tests if price is stationary around a linear trend, which is just perfect for orderly channels and pullback entries. It actually mathematically confirms if a directional move has real integrity rather than just being pure chaotic momentum.
All right, Section 4, Reading the Critical Levels. Let's talk about translating all this math into actual, actionable trades. So we need to know exactly when the market statistically stops being stationary, right? Here's the breakdown. When the KPSS is less than 5%, the market is stationary. You've got a stable range or an orderly trend depending on the mode you picked. But the moment that value pushes above the 5% threshold, while the math flat out rejects the null hypothesis, this strongly suggests non-stationary action like a legit breakout or a reversal. And if things get really wild and the KPSS spikes above 1%, you're looking at a severe deviation. That implies an aggressive regime shift or just a massive spike in volatility. It's basically the market screaming at you to pay attention. And finally, Section 5,
Visual feedback and settings. Let's look at customizing your dashboard.
To make these statistical alerts instantaneous during live, fast-paced analysis, the tool uses a Viridis color gradient system. This is huge because it means you don't have to sit there reading raw numbers all day. Brighter colors, like your glowing yellows and greens, represent highly stationary, predictable, and structured behavior. Meanwhile, darker colors, the purples and blues, represent non-stationary, volatile, and breaking out behavior. It literally lets you scan your chart in a split second to see if the current regime is glowing with stability or darkening into a breakout.
Now you might be wondering, okay, how do I actually configure the calculation window for this rolling test? Well, the default length is 100 bars, and honestly, this specific number hits the sweet spot. It offers the perfect balance between being hyper-responsive to new price action while still maintaining strict statistical accuracy across most chart timeframes. And since it updates on a rolling window, it acts as a live, breathing trading indicator, not just some static historical study you look at after the fact.
By objectively defining the market regime with actual math, this single indicator empowers a ton of diverse trading styles. We're talking mean reversion, range trading, trend following, breakout trading, and even just overarching regime filtering. It upgrades your entire approach by making absolutely sure you are choosing the right strategy for the current environment. Think about it. A breakout trader suddenly gets really interested when stationarity is lost, whereas a range trader needs it strictly maintained to survive.
As we wrap up this explainer, I want to leave you with a critical, kind of provocative question. You should really ask yourself this before entering your very next trade. Is your current trading strategy truly matched to today's statistical market regime? Or are you just guessing based on a visual chart? The math is sitting right there, ready to filter out the noise. It's totally up to you to actually apply it. Thank you so much for diving into the numbers with me today. Keep learning and always keep challenging what you see on the screen.